This is a promotional podcast for EIS Platforms Limited Trading as Growth Invest. Any comments made or opinions expressed in this podcast should not be construed as investment advice or a financial promotion. Startups and early stage businesses are high risk investments and you are unlikely to be protected if something goes wrong. Don't invest unless you are prepared to lose all your money. Hello and welcome to Alternative Thinking with me, Melissa Griffiths.
And me, Steve Dobson.
And we've also got our regular guests, Paul Mattick and Nick Priest. This is the podcast that takes a deeper dive into the alternative marketplace and exploring topical issues. Today's focus is reflections. Past season, 23-24 in the tax efficient space and also the state of the nation. So we've done a bit on EIS. Should we move on to IHT?
Yep. Sounds like my
your area, Nick.
My area, yeah. Okay, yeah. So look, it's not as easy as in the VCT or EIS market because people don't focus on that for tax year end so much. Maybe in the AIM market a little bit more for ISAs. But I think a pretty positive season in terms of funds raised as it looks at the moment. The last couple of years we've been raising around 1.92 billion. A couple of years before that was about 1.5, and to the end of January we were at about 1.3 billion, which is obviously down a little bit. That's not reporting everybody, so there's some people still to come in there, but also, you know, we have to consider there was a lot of talk about legislation the last two budget statements, and that would have probably made people sit on their hands a little bit.
Yeah. Which is even more, I guess, compelling because you mentioned it, a lot of people sat on their hands because there was so much uncertainty in terms of what was coming in the spring budget, etc. We've got a change of government potentially this year with the election. And the fact that the numbers are, I mean, we saw it as a platform. We saw
definitely picked up,
very little happen ahead of the spring budget, and then it's picked up since then because there's a little bit more clarity in terms of the path forward. So it definitely helps the marketplace, but yeah, it's still staggering.
Things have loosened up a lot, I think, since that last budget statement. A lot of sort of pipeline business, you like. Certainly, I mean, I can only really talk about our own business, but things have loosened up quite a bit, and we're now starting to see a bit more certainty about those deals coming through, which is really good. And
do you see it go more into asset backed as opposed to AIM, or?
Well, it's difficult to answer that question without a shameless plug for the Downing AIM portfolio. So here's a shameless plug for the Downing AIM portfolio. We've had a really good time, so we're performing very well, and so we've seen big upticks in the money coming in for us. But as I said earlier, it's quite difficult to know exactly what everybody else is doing in the AIM market. I think people can be wary of the AIM market because certainly over the last 4 or 5 years, you know, we've had COVID, we've had the Russia-Ukraine situation, a lot of volatility in the AIM market is hit by that very heavily. And you know, I can't remember, we were talking about the AIM VCTs before, but we have talked about them in the past. And when we're talking about the VCTs, you see people jump on that bandwagon when the market's down and then have amazing success in the market over a year and then think, oh, well, you know, it'll all be great again, and then lose 40% of the next year, and that kind of massive volatility. That's all very well when you're getting 30% tax relief on the way in. It's a bit different if you've accumulated money and saved up all this time and you want to kind of protect it. So the AIM market, I think people are a little bit wary of, but certainly in the unquoted, I think there's a bit more confidence in there. Not least because, you know, you're looking there at 5-6 managers who are solidly north of 500 million in terms of assets under management. A lot of them have been around for 5 or 5+ years, so you can start to look at them and say, well, you know, they say they'll do this, but how they actually performed, it's not sort of hypothetical performance. So you can kick the tires of these investments in the way that you might not have been able to do historically. It always used to be a deathbed scheme because people didn't really know what it was going to go into, and they say, well, okay, I understand it and hopefully it'll do well, but you know, we've ignored our IHT planning for a long time, and so now we've got no alternatives. But now I think it's a bit more mainstream because of the track record and because of the performance and because of the range of different managers that are out there providing the services. And I think, you know, when we look, again, I can only talk from our perspective, but if you look at the average age of an investor in our portfolio, I've been at Downing for 9 years. It's not hugely, but incrementally just gradually come down a little bit. And I think that is reflective of that. So.
Yeah. And I guess, I mean, you know, well, it's going to move us on really to more the state of the nation, where we feel the economy is, etc. But I guess as well, the more IPOs and listings we can get onto AIM, the more opportunity it gives again if they are IHT eligible to diversify AIM portfolios further for a lot of the, AIM providers as well. So let's sort of look at global VC economy. Any thoughts here?
Is it me again?
You again.
You always set the tone for us.
Right, yeah. Well, I think, yes, again, the hype era, I'm going to go to that. I'm just going to use that as a kind of a quick reference. And we've come beyond that period now. And the post-COVID hype, and then there was the kind of slackening off, and global VC crashed in 23. Whether it's 90% or 50%, it was down massively. And partly because of the less money going into these overpriced schemes and companies, and it kind of it's more a big rationalisation and probably appropriate. So we think it was the word hype is used intentionally, and I think a lot of the money was going into companies which were mispriced.
Yeah.
Now we are more rational, and it's been rationalised. And it is severely down in global VC, but it is starting to pick back up. We see some data from Real Deals and other way. You're seeing uplifts of global VC coming into the market. So it's down, different measures, say 60% down in 23, but now it's starting to creep back up again. So I think we've probably seen the worst of it, and now we're coming out through the bottom of the VC trough. And starting to see some value creation, and we talked about exits earlier on, and that will kind of accelerate the money going back into VC. So I think we're probably through the worst of it, and now in a upward trajectory, as I was saying earlier on. But there will be big hits still, and the thing it's very obvious at the moment. We're just coming out of a recession here, and we're talking about VC being down massively and EIS being down 45-50%. But then you look at the listed markets and you see they're at record highs, and it just feels a bit of they're very counter. One's at the bottom, one's at the top. And it seems quite odd. And I throw the question back over to you. And why is that? Do we think that's going to kind of come into alignment at some point? And it just seems a bit of an odd situation to have global highs and global lows at the same time in different asset classes.
I think that we were talking about this morning, in that there's a very concentrated driver behind that in terms of listed markets. People talk about the Magnificent Seven, and in the European markets you've got granolas. It's basically the same thing. It's 11 of the biggest companies that are really driving all this growth in the listed markets. People are very focused on that. If you take those out of people's portfolios, they've generally lagged a lot. And I think that there are comparisons to be made with the 70s there, where you're looking at massive companies who you can't imagine not being successful, and so people are piling their assets into those companies because it seems like the safe place, which is driving stock prices. But they're also looking at the Magnificent Seven. It's people like Apple and Google and these guys, and what's next on the agenda, as far as we're all concerned, is things like AI, and they seem like the natural home. But that doesn't necessarily, the 70s taught us, companies like IBM taught us, that what we expect to happen isn't necessarily what happens next. So while people are sitting there get in these stocks and driving stock markets up as a result of it, I think that maybe when we're looking at global VC markets, Ernst & Young were talking about the levels being down significantly in terms of funds raised, but also that there was a concentration there on just a small number of much larger deals, and actually the market might look a lot worse had it not been for those deals as well. But the 70s told us that cycle doesn't, even though it looks like it will go on forever, it doesn't go on forever. And so, I'm not saying it's any minute now or it's a matter of time, but the cycle will come round, and actually I think that will change. It will change as we see these tech companies coming through and coming up with the new ideas. It won't necessarily be Apple or Google, and that should open the market up, I think.
Yeah, I mean, I traded when I was younger. Actually came on to the trading floor when I was about 23, and that was in the TMT, which obviously was telecoms, media and technology back then. And I did see, how you almost are in a bubble and then it can collapse. I actually then wrote an interesting article a while back called ABC, which was my new predictions, which was AI, Bitcoin and cannabis as being the next drivers. So, but I agree with you, Nick. I mean, I think, you never know. There's a lot of hype and bubble, and it's actually what is going to sustain before. And I think we cannot, none of us can sit here and not address the fact that we're in a very, very difficult geopolitical climate as well, which inevitably will affect markets, and most possibly not in a positive light. Steve, any?
Well, so to pick up on Paul's point, there's a disconnect at the moment between the listed markets and the private markets. We know there's always a lag. It feels like that lag is longer at the moment. Listed markets will always price in the valuation sooner because of the nature of the beast it's listed on the market, whereas private markets, you don't get those valuation remarks as frequently. But, what's going to happen? Are we going to see listed markets collapse, or are we going to see private markets gain? It's probably a blend of the two, but I think, we're closer to the bottom, if not at the bottom, in the private markets. So, I think again, going back to things we've mentioned, it's probably looking more positive for the tax efficient space and the markets we're working in going forwards from here.
Which is great news for all of us then, isn't
Buying
it?
opportunity.
Buying opportunity.
Always.
Right, well, with that, I think we'll wrap up. So thank you, as always, to Nick and Paul and Steve, and we'll be looking at another topic soon. Just for anybody that is watching or listening, we'd love you to be able to like and rate and give us a review. And we're available on Apple, Amazon Music, and Spotify.
All good podcast services.
All good podcast services. And if anybody would like to see our lovely faces, we also are on the Growth Invest YouTube channel for video. Perfect. Thank you, guys.
Thank you.